Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always, Vinny Motiwala. And on the show, we try to decode different aspects of mutual fund investing, different categories, and few of the methods you can use while your mutual fund investments as well. And we're going to decode one of them today. And Vinny is going to give us a lowdown before we go across to our guests. Vinny, tell us more.
First up, we're going to talk on the IDCW. IDCW is what? It is actually an income distribution cum capital withdrawal that we are talking about. Now, what is this? Actually, this is just an option that you have, right? When you're picking up your mutual funds, if you select, there would be growth and IDCW. So what does that mean? A lowdown in terms of IDCW is not a mutual fund category. It's just simply an option, like I mentioned. One in 2021. It was called, before that it was called dividend option. There was an option according to that. Then it was renamed, and then it came in at income distribution cum capital withdrawal. And because of this, there was more clarity that came in that what does IDCW do? That when they pay out these dividends, that's exactly by the amount the dividend will be paid out, your NAV of the fund also will come out by that amount as well. So investors normally worry, what is this happening? You're getting extra bonus. No, it's not that. Your own money is coming back to you. Your NAV will get adjusted with that amount as well. Now, what's the taxation of this? Every IDCW payout is taxed at your income slab tax rate, right? So if you are in a growth fund, long-term capital gains, then you're taxed at that 12.5%. In IDCW, you will be taxed at your slab rate. So if you're on the higher end of the slab rate and 30%, then you will get taxed at that. Now, who should actually pick IDCW funds or that option that comes in there? Who should avoid it? Does it beat growth fund option at any point of time? Is it better than that? What are these other withdrawal methods maybe you can look at, if not IDCW as well? To discuss all of this, we are joined by Kshitij Mahajan, co-founder of Complete Circles Consultants, as well as Tarun Birani, founder and CEO at TBNG Capital Advisors, to talk to us about all of this. Gentlemen, good afternoon. Thank you so much for joining us on the show as always. Now, let's just start by that basic point, right? How should one decide in terms of IDCW and growth fund? When you have this option, why should you pick up IDCW or why should you pick up growth fund? The basic in terms of the highlights over there. Kshitij, let me start with you.
Well, good afternoon, Vinny. Thank you for having me on the show. So, it's a very interesting topic, and time and again, we keep on talking which one is good. So it depends firstly on the income slab of an individual. Let's say an individual who is not having any income and he or she has a window of that 12 lakh, which is open, or less than 12 lakh, which is open, they can still opt for IDCW plan because the tax, which is, as you mentioned in your starting statement, tax is as per the tax slab. So if you are not qualified as a tax giving person, then maybe you can look at IDCW. Second, if someone who is in need of funds at the same time, they want to start this monthly income option, and there is no monthly commitment which they want. It's not a 100% commitment by a fund that they are going to keep on giving every month dividends. So let's say in this market, which is like the last 1.5 years, we have seen hardly much movement in capital markets. In fact, markets have corrected. So it's not a surety product. If you are not depending on only this IDCW income for your monthly goals, then I think then you can still offer, again, clubbing it with the tax benefit. Now, someone who's looking at a growth option is the one who's actually looking at compounding machine for your investments. Because every time you keep on withdrawing from IDCW, it's your profit pool which is getting withdrawn. But when you do a growth option, and if you don't need the funds, it compounds much, much, much faster. Second, somebody who's at a high tax slab, this is totally a very unfriendly option, if you ask me, because whatever withdrawal you're taking from your from this dividend option, it's been taxed at a full tax. But at the same time, if you're in a growth option, if you need some funds, then it works like the capital appreciation part will be taxed on the basis of your 12.5 as long-term capital gain and 20% short-term capital gain, which is less than 1 year. So I think broader aspect is this, wherein I feel that these are the key things which one should take into account.
Okay, yes. So IDCW, it's slab rate at every distribution. So if you're in 10%, it'll be 10% on the dividend or the money that is paid out to you, and 30%, as Vinny pointed out earlier, if you are in that slab rate. Take that point, Kshitij. But you know, if somebody is looking at IDCW funds, so let me come across to you, Tarun, on this one. When evaluating IDCW funds, what metrics should investors look at beyond the payout history? Are there other things that one should consider, not just the payout amount?
Thank you for having me here. I think Kshitij broadly covered most of the points related to IDCW. I think what is more important for us is to understand the core principles of withdrawals. I feel these are not understood well, and due to which I have seen time and again the withdrawals have not been managed well, and a lot of behavioral mistakes which happens there. So let me try to come up with six core principle of withdrawals which everybody should be aware of while looking at withdrawing any point of time. First important point is that your portfolio is not a income machine, it is a wealth machine. One need to be very clear and understand this fact very clear, that if you have built a long term equity portfolio, it should be managed to produce income. It should not be, it should be managed to manage real wealth. The moment you start optimizing for yield, you begin making decisions that destroy that principle over time. So that is one very important part. I strongly feel sustainable withdrawal rate is 4 to 5% of the portfolio, not of returns. That is also one very important fact investors should be aware of, that 4% of the portfolio can be managed as a withdrawal based on Indian growth rate in the equity markets and all that what we have observed. So that is also one principle. If investors follow, they will be better off. Again, never sell equities to fund withdrawal in a down market. That is also a mistake where I have seen investor and investor returns have been very bad, because time and again withdrawals have been timed very badly and no plan has been made for that, due to which people miss out. According to me, SWP is the only rational withdrawal mechanism for the equity investment. I strongly feel the reason for it is the investor stays in equity, control the redemption amount, only the gain portion is taxed. IDCW destroys compounding by distributing capital on the fund manager's schedule, not on the investor's schedule. That is one of the most important problem. And I feel IDCW is only relevant for a very small set of investor where the income level falls in 5% tax slab or a 0% tax slab, which I don't think is exist anywhere currently. So I feel IDCW should not be discussed at all also, because this is actually not at all an option for in redemption.
But people are still giving it as an option, the mutual funds, Tarun. But anytime, any point of time, you know, they are idle investors, or who are these idle investors maybe who could even look at this option? And you're saying it's not an option that one should look at, so avoiding for most of them. But maybe if someone is looking at it, who should those investors be?
Yeah, so someone who is in a very low tax bracket, 5% tax bracket or 0% tax bracket, I think this is the only option available for them. Otherwise, I don't think for anyone else in the higher tax slab should actually look at it, because you have a SWP option where you can control it, time it, and manage it the way you want, right? Again, you are of the option that you find it very difficult to plan it. I think you just plan it once, let's say a 4% of portfolio, 3% of the portfolio, and just shut it. I think something like that can be built up as a withdrawal option in the SWP. But IDCW is just not making sense, because the post-tax returns, according to one study, that almost in a 15 year on a 1 crore corpus, the gap between the growth and the IDCW can easily be 25 to 35% of the terminal value, which is not a preference. And according to me, this is a planning failure completely.
Planning failure. And also I think the tax changes that came by is something that changed the way one looks at dividend funds as well, right? Nobody saw it coming, dividends getting taxed in the hands of the shareholder, which was earlier exempt. So I think that has changed this category completely. Kshitij, coming on this, of course, Tarun has said this is not a category for anyone unless it's a nil tax bracket that you're in. But any category from which, if there is dividend payout happening, apart from the tax benefit, which one would that be? I think, Kshitij, you're on mute.
My bad. Many categories have on the fixed income side also, where you have this option available, and many people, they don't have a risk appetite of equity. So for those type of investors, I think, and where there is a benefit of that, they don't have a income other than this income, then those type of investors are still looking at IDCW plan. There are many funds also where there is a consistency of payout, although there is no guarantee of payout, but seems like there is a consistency of payout which is happening. So those type of funds are still attracting people on the IDCW platform. So I think it's not one against another, but yes, if you're a long-term investor, you are looking at compounding your wealth. There is no other way but to go for a growth option and then SWP option. So we just did one comparison. Somebody with 10 lakh rupees starting and starting withdrawing at after 5 years time, and kept withdrawing till 25 years of the entire investment journey, and let's say investment growing at 12% and withdrawal is 6%. The difference is almost 50 lakh rupees of the corpus at the end of the tenor. 1.7 crore for a growth option with the SWP and 1.2 crore for a IDCW option, because tax is actually, and here we are taking 20% tax into account, not even 30% tax into account. So tax is a big deterrent in this entire part. So I think those people, again, I'm reiterating, where you have a tax slab which is not hitting you, then you can look at this type of plan. But again, your dependency is not only on this withdrawal, because there's no guarantee of withdrawal happening every month, irrespective of whatever track you have seen in the past. There can be a market moment like what happened in COVID and global financial crisis. We all were the part of it. So there were no withdrawals. If then the withdrawals are coming from the scheme, although it has to come from a surplus, they can't give it from the scheme. You will have to take a bigger hit.
Taken there, gentlemen. But on that note, we're actually going to slip into a very short break. We'll continue with the conversation and discussion in terms of what other withdrawal options can you all have as well in mutual fund. So stay tuned in for that.
Welcome back. You're still tuned into MF Corner. Still have with us Kshitij Mahajan, co-founder of Complete Circle Consultants, and Karun Birani, founder and CEO of TBNG Capital Advisors. Let me start with you, Tarun, this time. We are talking about maybe IDCW not being a way to go about your investments into mutual funds. But when somebody does need money, when to pick, say, SWP, you have STP as well. Explain it to us for our viewers and tell us how does one go about picking any of these ways of investments or withdrawing money from mutual funds?
Correct. So I feel this is a great question because investors often confuse the three. They sound similar, but they solve completely different problems. Let me try to separate them very clearly. Systematic transfer plan or STP is for accumulation phase. You use it when you have a lump sum sitting in your account and you want to deploy it gradually into equity. You park the money into a liquid or a similar parking option and instruct the AMC to transfer a fixed amount every month into your equity fund. It earns you a debt fund returns, and unemployed portion gives you a rupee cost averaging on the way in. STP is essentially a SIP funded from a lump sum. That's the main structure. Systematic withdrawal plan is for drawdown phase. You have a corpus, you need cash flow out. You instruct the AMC to redeem a fixed amount every month and credit it to your bank account. The corpus stays invested in the growth option. Only the gain portion of each withdrawal is taxed. And after 1 year, that gain is taxed at 12.5% LTCG. In the equity option. SWP, according to me, is one of the most disciplined way to convert a corpus into income. And according to me, it's a behavior hack. Like how SIP has helped in ensuring every month savings are going and ensures that market volatility doesn't impact your contribution into the markets. In the same way, when you require money to come in, the contributions are behaviorally completely managed through a SWP option. So it's a great option. IDCW, according to me, is a payout options within the same scheme. If the fund house decides when, how much, and from where, you don't have any control. After 2020, every rupee is taxed at the slab rate. That's the large problem, and I think we discussed it in detail. The narrow use case is a low bracket investor who genuinely cannot or will not operate a SWP. So my simple framework is STP when you are building wealth into a lump sum, SWP when you are spending wealth in a controlled way, and IDCW only when neither is operational feasible or tax bracket is very low. For everyone else, SWP from the growth is the answer according to me.
Okay,
That's the case.
SWP is the way for growth in terms for the way one should go about. STP is when you're building wealth, spending wealth is SWP, and IDCW comes in only when you're at that lower tax bracket, then maybe it does make sense. Thanks for that, but on that note, let's pick up a query as well. We have KM Khanna from Visakhapatnam who's writing to us and wants a few recommendations for systematic withdrawal plans at 25,000 rupees per month. At around 12% per annum, wants to know the lump sum amount that is required to be invested as he is superannuating in August 2026. How should they go about this as well? Kshitij, your take.
Well, Vinny, let's say if he requires fund for next 28 to 30 years, so in that case, the corpus will be around 30 lakh is if the corpus is growing at, let's say, 12%. So that assumption we have to take what type of funds he's investing into. And if you want withdrawals to sustain for that level, because every time, whenever you are withdrawing money, you are impacting your compounding also. And we always suggest 5 to 6% of the total, corpus one should look at on a higher side to withdraw. Let's say if the corpus has to last for 20 years, then he requires little less money. It can be doable with 25. But if the returns are at 10%, not 12%, and he wants the corpus for 20 years, then he has to look at 32, 34 lakh rupees of current investment to be parked, for his SWP plan. But his portfolio, if is fixed income heavy, and the average return expectation is around 8%, and for 20 years sustainability, then he need to have 42 to 43 lakh of rupees, which he has to park in funds right now, so that he can enjoy the benefit of the entire wealth. Because depending on the what rate you are generating revenue out of your entire corpus, your withdrawals impact in the same way, but your expenses remain same, so your longevity reduces. So I think ideal way to look at is just take 10-11% of expected return from your portfolio as a consideration, and take out 5% on a higher side from your portfolio, for the SWP plan. So that will help you to keep on enjoying the corpus if you, and God willing, if you live long, very long also.
Okay, all right. So that's about a query coming in. But the next question is, for retirement, say for a retiree needing regular cash flow, how does an IDCW plan stack up against SWP from a growth option? I think Tarun will say it's the SWP option that wins mostly. But is there a different answer to this, or one has to go through SWP or other options when it comes to getting back money during your retirement?
Right. So I think my answer to this will be a general principle. If one want to look at withdrawals, an inflation-linked withdrawal, a 4% safe withdrawal model, according to me, if you have done an asset allocation into various assets, and let's say 60-70% bias towards equity, then a 4% safe withdrawal is a beautiful structure which I feel over a long period of time one can follow. Let me try to explain that. How does this work? So let's say somebody has income requirement of 1 lakh rupees per month to come in. From a 4% safe withdrawal model, you need a 3 crore corpus to be invested, let's say, into a mix of assets. And if you have a high risk profile, let's say a 50 to 70% equity oriented portfolio, based on the past experience and past history, let's say the return of the overall portfolio is around 10%. Okay. So now out of this 10%, if you start withdrawing 4%, 6% keep compounding for you. That is one of the beautiful way, according to me, to create long-term wealth, at the same time making sure you are withdrawing 4% of the portfolio. One problem in this assumption is when there is a great market fall, like from September 2024, we have seen Indian markets have generated flat to negative returns. In that period, I strongly feel one need to have a cushion of 2 to 3 years of expenses available into a fixed income or a fixed deposit or liquid kind of structure where you can take up the money and you can stop the SWP at that point of time. So this ensures that behaviorally in a bad market you are not pulling out money from a portfolio which is going down, but at the same time you are ensuring that your corpus which is kept in the fixed income is used for that. I feel if anybody, just because you have retired, it does not mean that you should stop building or compounding your wealth. Only thing is you need to have a very strong structure. And this 4% safe withdrawal model, according to me, is a very good structure if anybody can build with a 2 to 3 years of contingency of funds, which will take care of bad markets. This will ensure your long-term compounding of funds keep happening, and you don't have to rely then on these options like IDCW. Yeah.
Okay. Tarun, a quick one. Amit Jadhav has actually written from Mumbai, a small business owner, and practically wants working capital periodically. So in SWP, STP, it's not fixed income option, but SWP, STP, is there a way maybe he could go about it? A quick one.
You want me to take this?
Yes, Tarun.
Yeah. First, an important clarification, SWP, STP and IDCW are not really fixed income tools. They are cash flow tools. Okay. Amit need to understand that the amount you receive depends on the underlying fund and the market conditions. So for a business owners who need a predictable buffer, the structure has to be designed very carefully. I feel he need to take care of two pockets, a two-pocket arrangement. One is and both in the growth options of mutual fund, both fully redeemable on demand. Pocket one is a working capital reserve, which you need to ensure park 3 to 6 months of typical working capital needs or the requirement in a liquid fund or a overnight fund. Basically in the growth options, when you need cash for the business, you redeem partially. That should sit in your liquid fund or ultra short term fund, not in equity. That is one very important part. You don't want to take market risk on that, and it should give you a risk free kind of return and available to you at that time. The pocket two is basically is your long term wealth, money you don't need for the next 2 or 3 years.
Okay.
That can sit in your diversified portfolio aligned with your risk profile.
Take that
Thank you.
point. Take that point, Tarun. That was very helpful. Kshitij, thank you so much for your insights as well. With that, we'll do one thing. We'll take your leave on this edition of MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.